jumpstart into chapter 11, a firm's sources of financing. And when a survey is being conducted for all startups, they say the most pressing and important need of a startup entrepreneur is a source of financing. Now let's take a look at some of the strategies. In this particular picture, it talks about whether you need to have a trade-off between debt and equity. Here in this picture, if you borrow to increase the source of funding for your own internal company for working capital or for other purposes, versus raising funds through selling of your shares, these are the advantages versus disadvantage. Let's take a look at this. For companies that has low debt and high equity, owners must share control with other equity investors who buy the stock or make a large investment. However, because the owners are giving up the shares to investors, the financial risk of the owner is much lower, which is quite logical. And the potential profitability will be much lower for the owner because you have a less amount of shares in ownership. Now let's take a look at another strategy whereby a company raises funds through debt from borrowing versus the amount of shares it sells to raise funds as an injection into the company. What is the result? The result is the owners maintain control of the company without having to make a large investment, which means that owners are not selling their shares or giving up their shares to external investors in order to raise funds. However, because owners are maintaining most of the shares, it will have to take on a higher financial risk. For example, in times of business downturn, or in times of business financial crisis, or in times of losses. The other potential profitability for debt financing is that the owners will have a higher potential return on investment for the owners. Well, this is logical because you're not selling out your shares, you're still maintaining the ownership of the company, mostly. Now let's take a look in this particular book. You've got, as a small startup, right? You can raise funds from these sources. Number one is your personal savings. As a small startup, you will have to break your piggy bank to see how much money you've got. And sometimes there are entrepreneurs who actually mortgage their house, sell their house, or sell their other businesses in order to raise funds for their new business. And also, you can actually raise funds from friends and family, which is called bootstrapping. Or you can actually get investments from other individual investors, and usually these are called the angel investors because usually they are the people who know you, who believe in you, and they are betting on you and your business, both you and your business, and therefore they are called angels. And of course, you can raise funds through banks, usually it's from loan, or you can actually raise funds from your business suppliers that you are buying goods from them, but you're going to pay them a little bit later. However, I should say that getting loan from banks and suppliers will probably give you a less chance of raising funds because as a small startup, there isn't much collateral for the bank or for the suppliers that they can hold on to in order to loan you the money. In Singapore, There are a lot of government-sponsored programs to support young entrepreneurs. There is a Seeds program. There is the other business angel fund matching programs. There is research investment programs. There is R&D funds for your IP development. So there are enough of government-sponsored funding programs in Singapore. However, it is competitive, and you've got to prove that your business is not only viable, but it must meet certain criteria. For example, new IP development, research development that is within the government spearheaded focused area of development for the economy. For example, if it's in water, it's in tech areas, they will probably get more visibility in funding and more possibility in funding than a startup that deals in selling of shoes, for example. And the next stage of funding is the venture capitalists. The VCs are the hardest to get the funding. You have to prove that you actually have a viable business model and also a viable IP that can break into industry with high disruptive growth. So venture capitalist funds are the hardest to obtain, but they will probably be a very popular source if you are a technology company. Well, here it also says that there are other financial institutions. There are large corporations that make investments. For example, the investment arm of Facebook, the investment arm of Google, or the investment arm of listed companies, which are seeking for acquisition growth, or they are seeking for acquiring certain complementary technology or IP. So that's another source of funding that you can get from large corporations. Well, the other thing to note is that getting funding from investors, which is external sources, are pretty difficult because you have to pitch for their funds, and it has to go through, and probably you have to go through many rounds of negotiation, and that takes up a lot of your time and energy from growing the business. So there is a risk and there is a trade-off. So this book tells you some of the research that's shown that for startups, this is the percentage of fundraising from startups. They get mostly, I should say that 44% of the startups get most of their funds from close family members and then through their friends. Alright, I should say that this book will tell you a little bit about fundraising and the sources of funding, and definitely in Singapore you can get a lot of support from the government if you go to Spring Singapore or IE Singapore, and they will actually give you the roadmap to raising funds from 50,000, the range from 50,000, 100,000 to 500,000 or to 5 million. So depending on what is your projection for your business growth, and also what is the need of the cash and for what reasons, you will have to justify through your finances. Alright, so this is what I want to talk about, the sources of funding for startups.